Last week's tutorial, we discussed on the potential cup and handle pattern. And I received comments on concerns that if prices head towards those levels, the economy will not be able to sustain those prices. And I too share the same concern as well. If that happens, the economy will have its setback initially, but subsequently it will adapt to a higher crude oil prices over time. And we saw how the economy has adapted to the high oil prices after the oil embargo in 1973 and after the war on terror in 2001 till today. Importantly, what can we do now and to preparing what's coming? This analysis is based on technical studies and does not constitute financial advice. Please consult your licensed broker before investing. I will bring you through on how the economy has adapted to those high prices during the past two events. And I will also explain on why, if the Strait of Hormuz crisis is resolved and with the unlimited resource of oil from underground in many countries, crude oil may not fall back to this median price of 50 US dollars. In 1973, and before the oil embargo, oil prices were trading at around $3.56. And after that crisis, it went straight up to 11.16. And that was at least three times more than before what the consumer have to pay. And few years later, it peaked at 39.50, and in that was in 1980. And that was 11 times more than that of before 1973. It gets more interesting here is that from 1980 to 2001, crude oil started trading in this range between 11 to 40 US dollars for 21 years. And it was during this period the economy started to adapt to crude oil prices between these levels, mainly because of real wage growth. And they can be uneven between countries. But between 1973 and 1980, during this period here, the turbulence period, it was a period where I said earlier, when crude oil prices multiplies, the economy will have its setback initially. After that, you'll find some stability. Let's go to 2001. And we saw how the global economy adapt to this median price of around 17 US dollars. If you're going to draw a straight line across during this whole period, we saw $17 for 21 years. And after 9/11, the global war on terror started with a launch of the second Gulf War in 2003. It sent the price from average of medium 17 US dollars to 147 US dollars. And that was 8 times more than before. If I were to benchmark it at 17 US dollars. And the same playbook. Initial years, the global economy went into panic mode around this period. But for the last 25 years, until today, the consumer have adapted to this price at the median price. If we are going to draw a straight line across, that would be around 50 US dollars. Why is that so? We are comfortable with crude oil prices at 50 US dollars. It is because of real wage growth. Real wage growth is the increase in our pay after it has been adjusted for inflation. How about if our annual wage outperform the annual inflation? And that's called positive real wage growth. And to achieve a positive real wage growth, we need to constantly add value to what we are doing. And to manage the next crisis where the crude oil may lever up from this median price of 50 US dollars, maybe to 100 US dollars. The key is to add value to our craft and increase our productivity. When crude oil started to stay above 100 US dollars, the world will initially feel the stress, but we are always capable to adapt. I will not be surprised to see that in time to come, that will be in the future, even if the median price is at 100 US dollars, it will be a new norm for most consumer. I always view that in every crisis, like the current crisis, the Strait of Hormuz crisis, it is a catalyst to adjust the price upward to where it's supposed to be because of money printing. Continuous money printing will only lead to inflation. Therefore, at the beginning of this video, we discussed that even if the crisis is resolved, crude oil may not fall back to this median price of 50 US dollars. And since the last few tutorial up to last year, and let's go to the tutorial about crude oil that I posted all the way to last year. And you know that I'm always pretty positive about what's coming ahead for crude oil based on some technical and some macroeconomics that I'm seeing here. So my motivation for crude oil since last year was and is always to look out for opportunity to buy on dips. Therefore, the long-term hold, we can consider the upstream crude oil assets. However, if I'm seeing an immediate opportunity, hedging and trading with futures and option is definitely what I enjoy. And I thought to give you some update from my last tutorial, the level I'm watching on the note that constantly looking out for opportunity to buy on dips. So this is a quarterly chart where we discussed before on this long-term uptrend channel. So I'm constantly looking for buying opportunity to buy on dips. And let's go into the daily perspective here. And if we can, let's look at where the crude oil started to move up even before the war or before the crisis. That was somewhere during this period in December last year. And let's narrow down to on the daily chart. And what I'm seeing here is if we're going to take this low to this high, and what I'm going to do here is what I saw then was this was a 61.8% retracement. For those who have an interest in retracement, that is something, a level that we should look out for, and that's 50%, that's 61.8% retracement. So this whole move is reacting very nicely to all these Fibonacci numbers, and that's technical. And definitely after that, that was last Friday, I got very interested in what's about to come. My name is Con Hao. I enjoy studying how different markets currently behave to uncover emerging trends, the potential trending markets of tomorrow. Feel free to leave any comments below. I'd love to exchange ideas with you on what is about to come. Really happy that I stayed through this tutorial. You have many great trading weeks ahead.